You're running full speed, but the markets are faster. Quasar Markets Live brings the world's top financial minds to you. Everything you need to know in one place. Learn from elite educators and gain a competitive edge, leveling the playing field for you. Join the conversation. Quasar Markets Live.
Good afternoon, Quasar Markets Live. And as it just said on the intro, I've got one of the legends of the industry himself, Michael Litt, here to join me. But I'm confused, Michael. You want to talk about earnings today? Everybody wants to talk about tax cuts, spending packages. You want to talk about something different. Why?
Oh, I don't know. Because I'm like, I'm just looking at the other direction as usual, right? I guess that.
Yeah, I just thought it was maybe you were saving that for Big Beat, who's traveling around on his boat here, spending all the Bitcoin I told him to buy 10 years ago.
Oh, right. Well, I'm glad you told him to buy the Bitcoin. And, I'm glad while we're here in the salt mines, he's off on a boat somewhere in the Caribbean, pretending he's a pirate, maybe listening to Jimmy Buffett.
Yeah, I'm sure.
So, I think we're going to, we don't have a fully baked tax and spending package yet. And there's going to be a lot to be said on that. I'm very interested to see how much leadership we have in the Senate, given the size of the deficits and the expansion of the total debt trajectory that is being projected on that. But again, we'll talk about that in coming weeks for sure. But
absolutely.
Today, E is for earnings, and I want to talk a little bit about earnings. We're just through earnings season. I think we have something like 95-96% of companies have reported now. So the first quarter is baked in the pie, and historically, let's look at what trend line earnings for the S&P 500 have been, and this is a logarithmic scale on the left side of S&P 500 earnings, as if you owned a share of the S&P. What are the earnings that you get for owning one share of an index at 5,800, 5,850? The trend line, the yellow line, compounds at about 6% real. And we've averaged, since this goes back to 1936, about 3%, 3.5% inflation. So you've had somewhere between a 9 and a 10% nominal compounding. And that's what the yellow line represents. The upper and lower bounds are 40% above the trend line and 40% below the trend line. We're going to see how that comes into play. Right now, you look at estimates through the end of 2026, and the earnings for 2026 was at 275, 274, it says on here. The trend line for 2026 is 220. So what has happened over time is that the actual nominal earnings, and these are nominal earnings we're talking about, which includes inflation plus your real growth, so that 9 to 10%. The black line is the actual earnings, and the yellow line is the trend line that goes through the black line. Over time, what has tended to happen is when earnings get 40% above trend line, they revert. And if there are recessions, then they tend to, nominal earnings will go below the trend line. Right now, we are at the top of the band for earnings. So we'll look at the next page to see what happens is when you do get above trend line, 40% above trend line, there tends to be a reversion. There has historically been a reversion on earnings, and there's no rule why that's true, but it has been true in the past. And we are right now, we are up against that upper band limit. And I will tell you that, and you can see what happens during recessions.
Right.
The tech bubble unwind there from 2000 to 2003. the credit crisis, GFC, where earnings came way down. And then there was a earnings recession. It wasn't technically an economic recession, Howard, but there was an earnings recession in 15, 16, right. and then again during COVID. And you can see that in those, other than GFC, you do get down towards the 40% band, and then you get a recovery. This upward trend we've had recently, I think, has been the earnings growth has been on the back of the consumer, which we've discussed time and time again. It's been the consumer that's been carrying the economy, and it's been probably the excessive amount of liquidity that was put into the system by the Biden administration in response to COVID. Now, we've talked about they're doing that because of the experience of GFC and the very slow recovery.
Right.
Wages after GFC, where wage growth was below inflation. And that's what really set up the issue that we faced, where people in the lower income stratas were kind of behind. Now, they had started to catch up since 2020 because wage growth has been running ahead of inflation, but there was a lot of liquidity in the system. The consumer had a great balance sheet. They brought their leverage down after GFC. They had a lot of flush with cash from the program, CARES Act, everything else that went on, and they were fully employed and getting really solid real wage gains. So that consumer brought us up to this level of earnings 40% over the trend line.
So I've got to ask, with that being said, do you really think we're at a peak in earnings right now?
That's the question. So let's look at where we are in valuation of those earnings. What are people willing to pay for those 40% over trend line earnings? Well, they were willing to pay a very high multiple, 29 times. Believe it or not, in the recovery we've had in the market, multiples are back up to that level. And I'm going to tell you, I say at or near recent peaks. They may actually be at peak because earnings revisions are coming down, Howard.
Right.
They're coming down. Let's look at the next page. Downward earnings revisions have increased sharply. And we're talking about earnings revisions numbers that rival the GFC and approach the pandemic levels. Wow. These are significant earnings revisions that we're starting to see out of companies. There is a large uncertainty around that number because of the fact that some companies are not giving our guidance.
I was about to ask that because I've seen so many that aren't even willing to delve into what might be. It's almost like hiding it.
I think that's right. But you are seeing downward earnings revisions from those that are willing to give guidance. So if we go to the next slide, historically, this is Yardeni's team, Edward Yardeni's group puts this together. This is the forward earnings growth. So 0% line would be no earnings growth, and 10%, 20% earnings growth, and then negative earnings growth. And you can see that the blue line is nominal, which is what we really look at, which is inflation plus the 6%. The red line is real, but we'll focus on the blue line, which is what gets reported, nominal earnings growth in dollars. So you will notice that during recession periods, earnings obviously fall. The blue line falls down into negative territory.
Right.
It can also fall down to the zero line in non-recessionary periods, meaning earnings growth will often be flat year over year, right? And you will have no earnings growth even in a non-recessionary period. We don't know if we're going to be in a recession or not. The probability, people are throwing probabilities all over the place. But what you can see recently is that the earnings growth at the far end of the chart has turned down. In fact, in October, earnings growth for the year was projected to be 14%. That projection is now down to 8% year over year, and it continues to sort of slowly migrate lower. Notice something else about the blue line. When it goes down sharply. And
Yeah,
the reason for
there
that,
isn't a lot of steps. It takes a lot of elevators, huh?
it comes down rapidly. And the reason for that is twofold. It's a behavioral thing. Richard Thaler at University of Chicago, who was a behavioral finance professor of mine, and other students of his, PhD students, have written on this. There's two reasons for this. One is company managements have been incented to achieve earnings growth targets. That's how they get compensated.
Yep.
It was a model that really got set up at GE under Jack Welch, and now most companies follow that pattern. So essentially, they say we're going to grow earnings, 8% next year, or 10% next year, and then they whip the team, their lieutenants, and the employee group, the management team, to get that done. So they are very bold in their projections. They're often a little too positive, but that's how they butter their bread. Second,
Right.
the analysts on Wall Street, some of the banks do business with those companies. The analysts personally want access to the management team and the information they provide. Being a favorable voice in the marketplace for their business model, their approach, the likely outcome, keeps the stock elevated. And so you have two boosters giving information to the marketplace. And when things go negative, you've got a few people out there like Jim Chanos, who's, always dark, but nobody, or the black swan crowd who, comes out all of a sudden
Right.
when the markets go down. But the truth of the matter is that boosterism kind of results in either no earnings growth or negative earnings growth periods not being well signaled to the marketplace. And so you get the downturns tend to be sharp. How sharp and how far will this downturn go? We don't know, but let's look at some more information to get back to your original question. This rally that we've seen, this retracement rally, as a technical guy would call it, the bounce back, had some legitimate fundamentals behind it. On the far left column, we're looking at earnings per share estimate growth, that growth estimate. So back to this chart we just looked at. On March 28th, the expectations were that the S&P 500, that group of companies in the S&P, which I think is something like 502 or 503, they would report an 8% year over year growth for Q1. So Q1 of 24 to Q1 25 would see 8% earnings growth. Well, what happened as earnings started to come in, you can see that number, as you climb up the table there, got to 14.3. In fact, I think it is now at 14.6%. So you had a very robust earnings season here. You had almost 7% better earnings growth than was expected. Now, that's the world we lived in. That's reflecting the economics we were dealing with up to March 31st, the world that we came into, and we've talked a lot about. The economy was strong. Corporate balance sheets were in great shape. Household balance sheets were in great shape. A lot of liquidity amongst the consumer. But look what happened to forward earnings guidance for Q2, Q3, and Q4. If we draw that red line up, any one of those columns, you see a deterioration in earnings growth on forward guidance. And that's what's reflected in that 14 down to 8%. We also, in the columns on the far right, where we saw a 0.7% outperformance on revenue growth in Q1, we now see over 1% deterioration in revenues. And you're dropping down below the original expectations for Q1 revenues. So you can see that forward guidance is deteriorating. Both the rally was on the back of very strong, legitimately strong earnings, the world we used to be in. And now the forward-looking world is not so rosy. So that's my answer to the question you asked me. Do I think we're at peak earnings? I think we're at peak growth. We already went past the peak in terms of earnings growth, right?
Okay.
And that I would expect that blue line, that sharp downward revision trend that we saw historically, to play itself out again. I believe that is going to happen when you have this kind of downward revision breath. You will get further downward. That trend that you see in the arrows you've drawn in Q2 and Q3, Q4, that trend is likely to continue, Howard. And that means that earnings growth is going to head down further from here.
Let me play devil's advocate a little bit, though. Isn't it possible that business is better than expectations, like we've seen in the earnings so far, with the numbers of the balance of the year get revised upward? I mean, tariffs haven't nearly had the impact on businesses that people are currently thinking they're going to have.
Not yet. In fact, what you say is possible for Q2. People are actually out buying things in advance of tariff pricing.
I know I have. I've seen it. I mean, I've seen that.
I did it too. I had a big piece of plumbing I had to buy, and Roll, ROHL, who sells parent and row faucets, has a big red thing on the top of their website that says all Roll product prices will be increased on June 13th.
Yeah.
Well,
I mean, the monitor that I'm looking at you at is because Best Buy, had a deal, and I said it's going to go twice as expensive in a month. Exactly.
So you've got Q2 may actually outperform a little bit because of the behavior that we're observing. It's funny because we'll get to Walmart later, but Walmart said we're going to raise prices. They got a response from the administration on that, as we all know. Target said they're trying to win market share, right? And struggling to do so. Only 15 of the 35 categories did they hold or gain market share. So in 20, they lost market share. And the CEO said that's unacceptable. That's a micro problem on their part. Home Depot said, we're not going to raise prices. Well, my plumber and my electrician came back with a bill and said they apologized because Home Depot's raised the prices on all the plumbing and electrical components they had to buy. So they bought 50
things. Say that. They already did on some of these too, without sort of saying it.
Home Depot said they weren't going to raise prices, but they have, and they are. So, look, the consumer is 70% of U.S. final sales demand. Okay. And as we said, they've been holding up this circus tent. Well, guess what? This is the University of Michigan. The consumer sentiment survey has plummeted now to a lower level than they've ever seen.
This is lower than COVID.
Lower than COVID. Okay. And if that is 70% of final demand, and they were holding up the tent, then I think that trajectory of that line is telling you what the trajectory of the earnings growth blue line we looked at earlier is going to be, Howard. That's the best leading indicator that we have right now. Now, this is where you get the old adage, it's different this time, comes into play. But
that's all I've heard for the last few months. That's all I've heard.
The words that people use are, oh, you need to look through this, right? Have you heard people say you need to look through this?
Oh, yeah. It's a short-term blip. Short-term blip.
It's short-term. That's a very prevalent psychology amongst market participants today. But now, 1-year inflation expectations exceed COVID. And we know how COVID was, people were really complaining about inflation, worried about it. It impacted markets. The Fed had to react. We now have 1 year. And again, this is just 1 year. So people say, oh, we can look through that. Well, guess what has happened, Howard? Next slide.
Sorry. Yeah, unanchored.
The 5-year inflation expectations have become unanchored. How many times have we heard Jerome Powell say long-term inflation expectations amongst households are well anchored.
Yeah.
It's a sentence that he repeats when he is leaning into, we can consider cutting rates,
Yeah,
right?
absolutely.
We can't look through that. You cannot look through five-year inflation expectations that have surged above 4%. The Fed is going to have to pay attention to that. That greatly reduces the probability that interest rates are going to be coming down. That is pressure. That's going to put downward pressure on earnings growth.
Sure.
It's going to put downward pressure on new home and existing home demand, right?
Yeah, absolutely is. I mean, mortgages are back above 7.
The bond market is not looking through this. The bond market is now seeing what's going on. This is important. And I've talked about the loss of foreign direct investment into the United States. I've shown that chart that goes up to $7 trillion. And I said that is going to turn over. And that turning over is pulling out one pillar of the American exceptionalism that we have enjoyed since the year 2000. Foreign banks and sovereign wealth funds are reducing their purchases of treasuries.
Yeah, I mean, we can see it, just in the way the markets moved the last couple of days, right? With everything the way it was going, yields should have gone down, not up, and just skyrocketed.
They really shot up. Two things happened there. One was a very large sovereign wealth fund called a bunch of their bond managers and told them they wanted to significantly shorten their duration exposure to U.S. Treasuries. Wow. That was right after they had seen some of these reports we're talking about and had seen the first details of the fiscal package that's moving through subcommittee right now. But they did not participate. That reduced participation in the 20-year auction. That went badly.
Yeah.
And that's why the 448 10-year suddenly became a 460 10-year.
Yeah.
So this is not going to change. This is, again, we see the downward trajectory. That's going to cause, all things being equal, rates to go higher. You saw it with the euro rebounding against the dollar. It moved from like 111 up to 113 and a half simultaneously. My guess is they're buying more European sovereign wealth bonds that are now have the same rating. In fact, in Hong Kong, there's a technical limitation now on how much treasuries can be owned by the pension plans, given the downgrade of the U.S. So there may also be some, not just strategic asset allocation decision making or concerns about policy, but also some technical factors. But this has now broken to a new low. Over the last 5 years, we have not seen this little participation in treasury auctions on the part. And look how big they are as a percentage. I mean, on average, you could draw a line and say, okay, well, they're 65. They're more. They're 2/3 of the treasury purchases, right?
And usually it looks like more around the 70% level.
Yeah, but that's 2/3. I mean, if that line gets down into the mid 50s or 50%, the term premium for the U.S. government borrowing money is going to go higher.
And we now have a tax and spending bill that looks like it's going to increase the deficit by about $3.5 trillion. Are we willing to talk about that yet?
We will. We're going to talk about it. I'm going to let that fish sort of sit out in the sun and gain a little more stink before I address it. Only because it's not fully baked into the pie. What I have read is the static read of what the cost to how much more government debt it would create. There's a dynamic element to each of these proposals, which is how do people react to tariffs? How much trade diverts away? right? How much blackmailing goes on, how much relabeling a Chinese product in Mexico and then shipping it, you go around tariffs. So you can't use a spreadsheet to calculate these things, because if you increase taxes or lower taxes, you might get more economic growth, you might get more investment. You don't know how it works out in a dynamic path. People are still working on models for dynamic assessment of this thing. Right now, we have relatively static scoring. So that's the reason I don't want to comment on it yet.
Okay.
Or because it's like, it's like trying to grade a test that somebody's only taken half the test so far.
Right. Yeah, you're trying to judge the finish without knowing, we're not at the finish line.
I'm just going to stick with what I'm concerned about, and that is E is for earnings, and none of what we're looking at. Now, Walmart's margins in the consumer. So Walmart imports $50 billion of goods from China annually. They import, I think China is 60% of their import. So there's another $40 billion of goods coming from other places that have a 10 to 15% tariff on it, right? So it's not just China. Their net income, if a 30% tariff on those Chinese goods equates to $15 billion of additional costs. Well, Walmart's got to come up with that scratch to pay the tariff, right? So they've got to foot the bill and then turn around. And we know that the CFO has said they're going to charge the consumer the $15 billion. Yep. Their total net income in 2024, by the way, at a 2.63% net profit margin, not 30%, 2.63 net. They cannot eat the tariffs, right? So 200 million customers who shop at Walmart are going to pay the tariffs. And as we saw from their consumer outlook on the economy and inflation, they know it. They're not stupid. They know it. The tariffs are a substantial consumption tax increase on the lowest quintiles of consumers. Who did we say was holding up the economic tent to get us to those earnings that were at the high end of the range above trend line?
It was the low to middle class that was spending the stimmy checks and taking that stuff and putting it into the market. We saw it.
It was the consumer. It was their consumer conferences. They're willing to spend. They're willing to believe they were going to be employed and getting wage gains. And guess what? This has as much of a psychological effect. And it's not the argument between the CFO and CEO at Walmart and the administration. And by the way, the $15 billion, you still got another sort of $4 to $5 billion to pay on your other imports. So now you're going to, now, do you want to pay 28 times earnings for Walmart if it's going to foot that bill and have zero earnings? That's not zero growth. That's zero earnings, Howard.
Yeah. Oh, no, I fully understand it. That's what I've been saying, once the administration came out and said, eat the tariffs, never mind the fact that they're supposed to protect the shareholders. That's the job of the CEO of Walmart. And, that's who get it protected. They just can't do it. He got a business. He'd be out of a job. And then, the next thing would be reorganization.
Some of the, for competitive reasons, market share reasons, Target, needs to gain market share. And I brought Target up for a reason. They might eat some of the tariffs for a short period of time to try to gain an advantage and get customers back in the store. But within 2, 3, 4 quarters, 100% of that plus the cost of capital. I mean, Walmart has a cost of capital. It's going to be out $15 billion of capital on an ongoing basis, right? So it has to finance that. Well, guess what? That's part of the cost that he has to pass. It's not just the 30%. And by the way, here we're talking about Walmart, and we're assuming Walmart goes directly to the manufacturer and gets its goods. But for a lot of smaller businesses, smaller retail operations, they get goods through intermediaries.
Absolutely.
Who are going to mark up the tariff plus the cost of capital. And I talked about the multiplier effect on those businesses. Those small businesses are privately owned businesses. A lot of those are going to get hurt worse because we're making a very simplifying assumption and assuming it's only 30%, because there is a cost of capital, there's intermediary upcharges. Our consumer was driving us to be 40% above trend line on earnings. They're taking the hit here. They know it. It's not going away. I do not believe you can look through the psychology change here, and that's the important point of this slide. All right, we talked 6 weeks ago or 8 weeks ago about the downturn in flights to the U.S. The World Tourism and Travel Council came out with revised estimates. Out of the 184 countries, they developed projections for. The U.S. is the only one that will see a decline in foreign tourists in 2025. We're unique. 183 are going to be up. The original expectations were for a 9% increase in the U.S., which is a strong increase because remember, we're still coming back from COVID-related international travel declines. People still have pent-up demand. They still want to have experiences, but bookings now for the UK and South Korea are down 15. Germany's down 28. Spain, Colombia, Ireland, Ecuador, DR down 24 to 33. Canada is tough to pinpoint, but the best estimate I found was down 35. We peaked on tourist revenue the year before COVID, and it's been coming back strongly. 181 billion in 24. The estimate for 25 was up 9% to 197. The revision now is 169. The actual revenues, because these are kind of the car rental, airline, hotel, sightseeing thing. These are kind of what I would call the primary spender. There's also a lot of shopping and
restaurants.
There's other spending that they build some restaurants in there, but the 217 number was, when you include all that, was actually 303. So it's about another 50% bump. And so the 197 would have been back close to 300 billion, but the 169 is, only going to be somewhere around 250 billion. So you're going to come off 40 to 50 billion dollars total of what would have been expected. Again, it's just one item. It's a big item. Most of it happens in the summer, right?
Right.
That's
where we're headed. All of these convergences that sound fairly negative to me seem to be hitting at the same time.
Well, you definitely have that. I would say what I'm trying to lay out here is that I see that earnings growth blue line continuing to come down.
So you do expect to see an earnings retreat?
I'm not sure I want to own, and if you're willing to say, I'm going to look through that,
right?
And I'll pay 28 times current, not forward. Forward multiple right now is 23.5 or 24. But again, it's getting more expensive. As that earnings growth rate comes down, the PE ratio goes up if the price of the market stays the same, because the denominator's dropping. That 275 number is now, for the 26, is now down to 268. Meaning the market's getting more expensive because the earnings are declining, and you probably have seen peak earnings are going to come back towards that trend line. How far back towards that trend line is tough to say, but what happens in markets psychologically is people see growth coming down to 0%. We don't go into a recession, but you get flat earnings year over year. People don't want to pay 24 times next year's earnings for flat earnings, do they, Howard?
No. I mean, we've seen it with, Palo Alto yesterday, right? With their earnings and getting hit real hard, and many others that, if you can't justify those sky high PEs, the market, reacts pretty quickly, like you said. So you're definitely thinking we're seeing the beginning of this earnings retreat. The market is trading at what you would call probably a higher than it should multiple of its peak earnings.
That's right. And because if growth is coming back to, and I'm not saying, even if we assume no recession, but you have, low single digit or flat earnings year over year, if we say let's say the second quarter, we get this consumption bump that you and I have participated in anticipation. But if you say July 1st of 25 to June 30th of 26, that 12-month period, you're going to be flat on earnings. I don't want to own the market at these multiples because I
No.
see multiple contraction, right?
Yeah.
Do
I
you
guess
come
this
down to
explains why my
22
Bitcoin's
times
taken off.
earnings, 21, 18 times, 20, 18, anything between 18 and 22 times earnings would be in play. And you
Okay.
do the math on flat earnings year over year and an 18 to 22 multiple, and you start to get a range of S&P levels that is somewhere between 8 and 18% below current levels, right?
Wow.
All based on earnings. That's before we even get to the tax and spending package, Howard. I wanted to establish that you have a real, a verifiable risk here, and the underlying pillar that was holding those earnings. We are at peaks, 40% over trend line earnings. We're trading at very high multiples. People are looking through a lot of things that I don't think you can look through anymore. And you always have to know who the rube is at the table, right?
Or you are.
Or you are. And in this instance, there are more than one rube at the table because there are so many people who will give that refrain to you. You have to look through these things.
Yeah.
That I believe. And I go back to one thing. In 2007, August of 2007, given what we knew was fundamentally going on inside subprime mortgages, we were convinced that Lehman Brothers and Bear Stearns, given the amount of that product they owned and given the leverage they had on their balance sheets, that we were convinced they were both technically insolvent. Now, I didn't say bankrupt. I said technically insolvent. Okay? We knew in August of 2007, I remember having conversations with people who told me and my colleagues at Frontpoint we were crazy. March of 2008, Bear Stearns goes bankrupt. September of 2008, Lehman goes bankrupt.
Yeah.
But we knew they were technically insolvent in August. Sometimes knowing fundamentals you can be early, and now you would think, well, everybody else should have seen that and known that. No, because people didn't want to believe that. They were making so much money issuing structured credit,
right? That they just
with that sort of content in them and the banks were making money underwriting it. The managers were making money, getting paid fees to do it. And the momentum was, if you looked in the rearview mirror, the performance was there. So don't underestimate the market's inability to digest fundamental information like this earnings discussion we've had today and incorporate it into the price of securities in the marketplace.
That is some great knowledge from Michael Litt here, global investment strategist who comes on to Quasar Markets every month or so and gives us this information that you can't find other places. Michael, thank you so much. So I guess next time is when we'll get into taxes finally.
Actually, we may actually get it. Next time we're going to talk about the threat to what I'm going to call next week's the highway to the danger zone. And it's about the defunding of university research and how that has been one of the key pillars to American exceptionalism since World War II. And it may be at risk now.
Wow. I don't argue with that at all. I've seen, I've seen it, what's happening here in the Northeast with all of these universities. And we've seen that's why Bill Gates and his now going to give away all his money so quickly to try to counteract it. But there isn't enough out there of this foundation.
And then when the pie gets baked a little more, we'll certainly get back to the tax and spending bill. But everybody else is talking about that right now. I want to talk about some other stuff that I think you don't want to miss.
Absolutely. Well, thank you again. Michael Litt always brings the best information here to Quasar Markets Live. Thank you so much from us, and we will see you all tomorrow morning at 9 a.m. Thank you.